When you join the Forex trading business, you have to learn a new language. Imagine you're living in a foreign country and you don't speak the language. How will your life be? Japanese candlesticks are the language of the financial markets. If you know how to read Japanese candlesticks, you'll excel in your business and you'll become a profitable trader. Where do we learn this language? The Candlestick Trading Bible. Welcome to Lady Africa Forex YouTube channel. My name is Daniela. So in this video, we are going to learn about the candlestick anatomy, important things to note about the candlesticks, the type of candlestick patterns you will see in charts, possible meaning of candlestick patterns, and then eventually we will review a few examples of candlestick patterns on a chart. A candlestick is a graphical representation of price movement. It's made up of a body and wicks. There is a bearish candlestick, commonly represented by red color. There is a bullish candlestick, commonly represented by color green. When you see a candlestick, you'll be able to see price movement during a particular session or within a specific time frame. So here I have two candlesticks, one red in color, which is the bearish candlestick, and the second one is green in color, which is the bullish candlestick. So a bearish candlestick will show you reduction in price at the market, whereas a bullish candlestick will depict increase in price. So if we pick the bearish candlestick, you see it has a body. The body is the filled part. Pick a different part. The body is this filled part. That's the body. And then the two lines poking above and below the body are the wicks. You can either call them wicks or shadows of pins. So that is the anatomy of the candlestick. Remember, it has a body, the filled part, and it has two lines poking above and below, which are called the wicks. So the candlestick will show you the open price. So this is the open price for the bearish candle, and then it will also show you a close price. This is where you'll find your price point during the close of the market session. It will also show you the high. This is the highest price point during that market session, and also the lowest price point during the market session. And then at the end of the market session, definitely the candle will close. So if you opened here, you're going to close here. So during price movement, price will open here, and then there will be price movement within this range. From the open to the high to the low, then it will close here. So for example, in a bearish market, we know it represents price moving lower. In a bearish market, probably, let's say today your tradable item you've opened here, you'll open the price at $10. Then price will move within this range between here, $10 to the high. It can go, let's say, up to $15. So from $10, it went all the way to $15. Then continued with the range, went again all the way as low as, let's say, $1. As low as $1. Then ultimately the price closed here at $2. So this is a graphical representation of a bearish market, which shows you where the price opened at $10, price moved within this range, went as high as $15, went as low as $1, but closed at $2. On the other hand, we have a bullish market. Our second candlestick is green in color, like I mentioned. Green represents bullish market, buying market, or buyers are in control. So this is our bullish market. This is the body of our bullish candlestick. These are the wicks here, upper wick and then lower wick attached to the body. During the buying session, during the bullish market, price will open at the lower side and then will close at a higher price point. So for example, here in this bullish market, as when you look at this bullish candle, you know we open price here at, let's say, $10. Probably price went as low. This is the lowest point the price went, as low as $5. Then price range within this area during the market session. So the bullish candlestick has the close above. It will close here above the open, and the price will always open at the lowest price point. It will move within the range, and then buyers will flex their muscles and bid the price higher. They can go as high as, let's say here it went as high as $50. You opened at $10, you went as low as $5 and also went as high as $50 and ultimately closed here at $30. So that is how you interpret the candlestick, and that is the psychology behind the candlestick. Remember, the anatomy has a body and two wicks. There is the open and the close of each candlestick during any market session, and bearish market is represented by a red candlestick. A bullish market is represented by a green candlestick. When the market is bearish, sellers are in control. They bid the price as low as they can. When the market is bullish, buyers are in control and they bid market price as high as they possibly can. Now let's see what important information we need to derive from the candlestick. First is the size of the body of the candlestick. Then we will see the size of the wick of the candlestick, the color of the candlestick, and the location of the candlestick. The size of the body of the candlestick is very important. A candlestick with a big body will show a lot of strength in the market, and a small body will show diminishing market strength. More often than not, a group of small body candles will show there's little or no activity in the market at that particular point. So the size of a candlestick shows the sentiments in the market, regardless of the color and whether it's bullish or bearish. Secondly, the size of the wick of the candlestick is important. Some candlesticks have long wicks while others have short wicks. Depending on the type of candlesticks, there are candlesticks where the body is the most important, and there are some candlesticks where the wicks are significant. Then we'll also see the color of the candlestick. At times, you'll be required to pay attention to the color for you to read the sentiments of the market. The color of the candlesticks inform you what type of market you're dealing with during that trading session. Well, of course, red means selling and green means you're buying. However, there are some types of candlesticks where the color may not really hold water, whereas there are other types where the color is very, very important. Last but not least, the location is the most important among these items here. The location is very, very important. Location of a candlestick is the most important factor to consider when trading. This is when you ask yourself, at what point has that candlestick formed on that trend? If you're on a trending market, or even if it's on a range-based market, at what point has the candlestick formed? Has it formed at your point of interest? Has it formed at the beginning of the trend? Has it formed at the beginning of a retracement? And this is important because this information will help you know what to do at that particular point in time. Whether you will execute a trade, whether you'll hold a position to an existing trade, whether you'll add more trades, or even whether to exit the trade, and altogether whether to stay away from the market. Then let's look at the shapes. Here I have a few examples of candlesticks with different shapes and sizes. You can see the first one has a small body. This is the first one here. This is the first one. It has a small body and it has 2 wicks above and below it. Same as the second one. Although the colors are different, but the size of the bodies are the same. So there's a wick up below it, there's a wick above it, there's a wick below it, there's a wick above it, there's a wick below it. But you see the sizes of the bodies are small. So regardless of the color, these two candlesticks will show you the sentiments of the market, whether there is activity or not. Then if we look at this third candle here, it has a very big body. Remember, this is the body. However, this does not have any wicks. There are no wicks either above or below. And the fact that the candle is big, it shows strength in the market. And with regards to color, definitely, like we said, green means it's a buying market. So if you are on a trend and you see several of these big green candlesticks with no body wicks following each other, they show that the market is trending, there is strength. You can continue holding that position or you can add more positions. If you see a cluster of these small bodies, several of them, add a few here, clustered together with no strength, it means there is little or no activity in the market. So the best decision you can make is stay away from the market and wait for another session where there is activity so that you can be a profitable trader. Then below here is a group of candlesticks with no bodies, but they have wicks. Some have short wicks, others have long wicks. Like if I pick this one has no body, but it has a wick above and a wick below it. The wicks are short in comparison to this second one. This second one has longer wicks with no body. The third one here, it just has a wick on one side, no body, no wick below it. Same applies to this fourth one. It has only one-sided wick, no body, no wick above here. So they all give different meanings, different sentiments in the market. Of course, here and they all have names after all. So of course, if we look at this dragonfly, it has a wick below, a long wick below. And if you were to look at the psychology behind it, we will see that the wick, the price opened here. This is where the price opened, and it's the same place the price closed. So the open and the close of the price was at the same price point. So if it was $1,000, price opened at $1,000 and closed at $1,000. However, it did not go any higher, but it went lower. So the price went lower past the open. Probably it went all the way to $500. That was the low of the price. Then price came back and closed at the same price point, that is $1,000. So this definitely, what's the psychology behind it? Definitely, it means sellers try to push the price lower and buyers also bid the price higher, but because nobody outdid the other one, they ended up closing the price at the same price point. So nobody really was in control, neither the sellers nor the buyers, and things like that. For a candlestick like this, the long-legged one, in most cases, it represents indecision. So no decision is made yet in the market as to which direction the price should move, whether to go bullish or bearish, because the price opened and closed at the same price point. There was a tug of war between the buyers and the sellers. So that's it for now. Those are the basic body shapes and sizes that I could come about. However, that's not all. There are so many other candlesticks, patterns and shapes and sizes and designs. If you read the Candlestick Bible, you'll find all of them. You'll see the psychology behind them. These are just a few examples just to help us get the gist of it. Moving on, let's see the types of candlestick patterns. And remember, candlestick patterns are an integral part of technical analysis. They give you valuable information about price action. So today we'll see single candlestick patterns, we'll see double candlestick patterns, we'll also see how triple candlestick patterns look like on a chart. So most of the candlestick patterns are used for trend identification and market sentiments, to determine the strength of the trend, identification of reversal points, and for trade entry and trade exit. For single candlestick patterns, these are candlestick patterns which are formed only by one candlestick. So we have an example of a single candlestick pattern here. They are used to identify possible trend reversals, and also remember the color is not important. It's complete on its own, and the information it will give you is enough to help you determine the price action. So here we have one called the pin bar. This one is called the pin bar. Remember, we looked at the shapes and sizes of different candlestick patterns. With the pin bar, it has a very small body in relation to its wicks. This is the body, and the wicks are very long, either on the lower side or on the upper side. So remember, this is the head or the body of the candlestick of the pin bar, and this is the tail of the pin bar. Since it comes in single on its own, it will give you complete information on what is happening on the market. Most of the time, it's used to identify possible trend reversals, and the color may not be important, because you can find a green pin bar on a trending market, buying trending market, or even a red pin bar still on a buying trending market. So here, if we look at this example here, this one here, you can see there are other previous candles. It was on a selling cycle. Other previous bearish candles were coming down, coming down, coming down. This arrow depicts an old trend here. And then this is a bearish candle, which shows that we are on a selling cycle, sellers are in control. Then at the end of the trend here, a pin bar forms. The pin bar shows you possible reversal, and in this market at this point of trading session, as soon as the pin bar, remember the open and the close, as soon as the pin bar closed here, the next candle is a bullish candle. This is now the next candle, which is a bullish candle. It opened here and closed above, and from there on a new trend started, and the market cycle transitioned from a selling cycle to a buying cycle. So this is just one example of a single candlestick pattern. There are so many. If you read the Candlestick Bible, you'll see a variety of them. Another example is a double candlestick pattern. For double candlestick patterns, you require to see two candlesticks. Two candlesticks are needed to for the pattern to be complete. They come in pairs, and an example is an engulfing candlestick pattern. Here I have an example of an engulfing candlestick pattern. I have two. We have the bullish engulfing candlestick pattern and bearish engulfing candlestick pattern. So you see, it's comprised of two bars. If we come here to the first example, we have the first bar. This is the first bar, and this is the second bar. So it's comprised of two bars on a price chart. The second candlestick will be much larger than the first candlestick. So this first candlestick here, this was the open of the candlestick, and this was the close. So during this trading session, when it was on a selling cycle, probably there were other candles coming down, so selling cycle. Eventually, this selling cycle closed here. The market session ended here when it closed. Then the second candlestick opened here and closed way above the first candlestick. And if you can see, if you can compare the two candlesticks, you see the body size. This one is long, yes, but the second one is much longer. So the length of the second candlestick is much larger than the first candlestick. And it will completely engulf or even cover, completely consume the first one. So this one opened here, closed here. The first candle is completely engulfed by the second candlestick. So when you see such a candlestick, then it indicates there is going to be a market reversal. So a double candlestick pattern shows possible change in the direction of the price movement. So we've seen bullish engulfing. There's also bearish engulfing. The first candlestick opened here, price opened here, and price closed above the open. The length of the candlestick, yes, it's big, but in comparison to the second bar has totally consumed the first bar. The second bar opened up here and closed up here. So the price action of the second candlestick has totally shifted from the price action of the first candlestick. So market was going up, closed here, closed there, opened, shifted, closed below. So the bearish engulfing candlestick pattern, the second bar has completely consumed the first bar, and that is why it's called an engulfing candlestick pattern. So this also is one example of candlestick patterns that come in pairs, come in double patterns. There are so many others that you can learn from the Candlestick Bible. Now we have our pair here of bullish engulfing. This first candle is way smaller than the second candle. The open price of the first candle is here, and the close price is here. Then the second candle opened at a lower price point of that market here and closed here. In the process, it has shifted the market all the way up now from the selling cycle to the bullish cycle. So if you are looking at a chart at this price point, your decision is to look for buying opportunities. Where do you enter your trade? And that's it with double candlestick patterns. Finally, we have triple candlestick patterns. Triple candlestick patterns, you require 3 candlesticks to complete a pattern. And an example of a triple candlestick pattern that I have here is the evening star. So mostly the evening star is seen near the end of an uptrend. The first candle should be long and bullish. The second candle should be at the top. And in most cases, the second candle is a doji. and then the third candle will now signal the beginning of a reversal. So here I have an example. There are two types of the stars. There's the morning star and there's the evening star. The evening star is here. With the evening star, like I said, you're going to see it near the end of an uptrend. So the bullish candle, first candle is a bullish candle representing a bullish market. We are buying, we are buying, we are buying. Then the second candle is a doji. This is a candle which has no body and it has 2 wicks up and above. So a candlestick with no body is called a doji. In most cases, it represents indecision. So the market was going up and then it got to this point. There was some indecision whether the price should continue higher or not. Then the third candlestick here shifts the market now. So now the sellers come in, take in control of the market. They open the price here and then they close the price here. So the market has shifted from a bullish market to a selling market. Why is it called an evening star? Well, it's like now the sun is setting. The sun was rising in a bullish market. It got to this point where there is no more going higher, then it eventually sets. So it sets the pace for a selling cycle. Now you start looking for selling opportunities. The reverse is the morning star. This first example here is an example of a morning star where now market was going down, going down, going down. So if it was the sun is setting, got to this point, then now it's rising again. That's why it's called a morning star. The principles are the same. Sellers were in control. They opened the price here, closed here, got to this point here. There is indecision. Definitely price. They tried to push the price lower, closed here, push the price back, close above. Then a new beginning started here. Market opened here and closed here, and it started the pace for a new trend. So morning star, evening star, those are triple candlestick patterns that show possible change in direction of price movement. Remember, most of the time you find them at the end of a trend, so you look for opportunities. So if you see a morning star, you look for buying opportunities. If you see an evening star, you look for selling opportunities. The figure number 3 here shows how you can see them, you can identify these candlestick patterns on a chart. So just like I demonstrated, you can see three bearish candlesticks coming down, got to this point in the market. The prices have gone as low as they could possibly go. Then there was an indecision here. Then price shifted. The 3 candles formed a pattern, a morning star. Now we start rising. Markets prices start moving higher. We look for buying opportunities. Same with this last figure here. It was a bullish market. The first candle here is bullish. The second candle is doji. The third candle is bearish and it closes below. So we reverse, trend reversal. During that session, we start looking for selling opportunities. Now, I have a chart example of engulfing candlestick pattern. As you can see, initially the price was moving higher in a bullish market. From low here, higher, 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 this is a bullish market. Then a bearish engulfing candlestick pattern forms at the highest price point, indicating imminent reversal. So our bearish engulfing candlestick pattern is here. This is the highest price point. This is a bullish candle. This is a bearish candle just that has engulfed this bullish one. So the two make bearish engulfing candlestick pattern. So let's see what happens next after the pattern forms. Clearly, we see a new trend has begun. The price has shifted to a selling cycle. It's time to sell. It's time to look for selling opportunities because trend has reversed from bullish to bearish. Finally, the pin bar chart example. We can see this is a selling cycle. Price has been pushing lower and lower and lower. A pin bar has formed at the bottom of a selling market. Our pin bar is right here. Small body and a very long wick at the bottom there. Price has moved to the lowest price point during this market session. So let's see what happens. Following the pin bar, there is a spike in the price in the opposite direction. A new buying cycle has begun. It's time to look for buying opportunities. We are buying. Price is pushing higher and higher and higher. I hope you've learned the basics, but there's a lot more to cover. The Candlestick Trading Bible is so extensive, we cannot cover everything in one video. Take time, read the Candlestick Bible, learn the new language. Better yet, get a mentor to walk with you the Forex trading journey. At Lady Africa Forex Trading Channel, we offer mentorship to beginners and struggling Forex traders. Thank you for watching. Don't forget to subscribe and see you in the next video.